Everybody, welcome. Today we are going to discuss alternative commercial assets such as self-storage and mobile home parks and industrial property. We're going to talk about the profitability, what this looks like to you, and what's the after-tax effect. We're joined by Jeremiah Boucher, who is the founder of Patriot Holdings, which does these alternative commercial real estate investments and syndicates properties. And if you are interested, you can also be an investor in his properties. We also have his controller, Chris Warfield, to help us dive into some of the minutia of the accounting elements of his real estate. So really excited to talk about this. Lots of cool things we can talk about. But I'll let you guys, Chris and Jeremiah, why don't you introduce each of yourselves in 60 seconds or less?
Yeah, so right now I'm at this biohacking conference, so I'm in the middle of the conference. I'll make it quick for everybody. So Mark, we met at Genius Network. I've been in for a couple of years, and I focus on buying mobile home parks and self-storage facilities. I've been doing it for 15 plus years. Just a long time real estate guy, and I realized that these diversified streams of income were the way to go for me because I lost everything in 2008. I was buying single family homes in Las Vegas, and I knew I had to have an edge or a niche. And then I found myself in these asset classes by just reading courses, getting some mentors, helping some guys roll up a big fund, and then learning the nuances of how to invest in these and caught the wave. So the last 10 years, really learned how to buy these mobile home parks and self-storage facilities in suburban and tertiary markets and add a lot of value because they're quite mismanaged. And there's at one point was not a lot of competition. So it's worked out well for us, but this is, we're very focused on aggregating the entire portfolio and then someday selling it off to a larger storage REIT.
Awesome. And Chris.
Well, thanks for having us on, Mark. Yes, I've been with Jeremiah for the last 5 or so years here. Started out as the accounting manager, kind of working my way up with him. Prior to that, I was born and raised by a CPA, so 38 years CPA veteran. Kind of been stuck in the tax world my whole life, from filing in the office in the summers when I was 14, 15 years old, all the way through school and to where we are at now. So I've got about a decade and a half of experience working in a CPA office. And like I said, about 5 years ago, Jeremiah was a client actually of my dad's partner. Started working together and built a relationship. I had a passion for real estate. I knew he was really passionate about real estate and very successful in the field. And we made a connection. And long story short, I moved out to Vegas and we kicked off this relationship. So been working on the tax and accounting side ever since with him.
All right, awesome. So now also I just want to note for those of you in attendance, we're going to walk through some questions. We're going to walk through the interview, but put your questions in the Q&A section. Feel free to put some comments in the chat. We'll answer all of your questions either throughout the conversation or at the end of the conversation. And we'll talk about how you can potentially invest in these products, get started, all that wonderful stuff. Now, Jeremiah, you have your book called Getting Your Edge. Getting Your Edge, right? What's the full title?
Finding Your Edge.
Finding Your Edge. Sorry. So I read it and I want to talk about some of the things in this book that are really interesting. But before so some of the things that at first when I saw, a guy who owns a business sends me a book, I was like, okay, this is just going to be a little thing selling what he does. I had low expectations because I thought it would just be something promotional, but I was like, wow, this is actually a really useful book for people who are either getting started or want to get into higher levels of real estate. And it's pretty comprehensive, and it talks about mindset, controlling your emotions, being creative, finding alternative solutions, and it also tells it in a story manner so you can actually read along and feel like I feel like I know you a lot more now in your background. Talk about your background in sports and some of your failures and some of your favorite books and mentors and coaching programs and all the good stuff and the key attributes that got you to where you were and in particular, thinking outside the box and being resourceful and creative. But we can't continue on until there's one thing we absolutely have to talk about, which is the tornado. That's what probably what stood out most. Can you tell me, maybe give me a little more details and tell the audience what happened with the tornado?
Yeah, so when I was starting out, this was around 2009, 2008, after I lost everything. And like I said, thanks for reading it, Mark. You actually did read it. So I was living on a buddy's couch in a foreclosed home. And at the time, a lot of foreclosures in the market in Vegas, all over the country.
Vegas got hit hard. Yeah.
Yeah, real hard. Yeah. I mean, there was tons of vacant houses. So I was living in one. And with that, I found this mentor, Dave Reynolds. He's kind of one of the recent godfathers over the last 30 years of mobile home park investing. And what we were doing is I went out, found this deal. We went out and I met him out there. We went and bought this mobile home park in Lone Grove, Oklahoma, and right on the border of Texas. And we put so much work into it. It was a real rough park. And I said this briefly, the story in there about the owner, the house was full of rats and there's full of cockroaches and there was Coke and soda and chips everywhere. And this guy was just on his last leg with his health. And he ended up working with me. And I didn't even know what I was doing at this time, and I felt so awkward in his house trying to get that deal done. And once we got it done, we actually turned it around and we were able to get a better community for the residents. It was all ready to go to sell. And I was expecting a check because we had some Utah investors buying it. We were going to make, my first, I think it was 150 grand. And I'm on the treadmill over at the LVAC. It's the gym in Vegas. And I'm looking up and I'm watching the news and it's 5:00, the news, national news. And it says, terror strikes Lone Grove. And then I'm looking at the aerial footage from the helicopter and I'm like, oh my God, that's a mobile home park. And I'm like, oh my God, I think that's my mobile home park where this, the homes were wrapped up in the power lines. And it was a tragic thing and people passed away and it was an absolute mess. And I realized, I'm like, oh man, I mean, one, that's a horrible thing. We got to get out there and get on top of it. And two, I just lost everything that I was working for over the last 2 years. And I had a great partner and we handled it and ended up breaking even and not getting that money, but we got it off our books. But the bigger lesson was that night I was reading, or a week or two before, Sam Walton's book, and it talked about him opening up his first Walmart, and I don't know what he called it back at the time, and it was in Arkansas, and that same thing happened to him. He worked 2 to 5 years, got all his inventory he saved up for, he put it in the shop, and then this tornado just wiped out his store, and he was just, it didn't perturb. I mean, it didn't even stop him. It just kept going. So, you know what? I'm like, if this guy did it, he's American icon and legend. I can do it. So I'm just going to move forward. I learned this problem. I'm not going to buy in these areas anymore. And I'm going to make this thing happen. I don't care what it takes. And I got through it and found a lot of good deals, but that took a lot of fortitude on that one.
What was the first thing you did when you figured out that was happening? What was your first order of action?
Well, I didn't know if it was sensationalism or hype or what, and it hit so fast that, my partner and I hopped on the phone. I mean, it was literally in real time. So, we had to get obviously damage control figured out where we had to make sure that there was public utilities out there, making sure to turn the power off and making sure people weren't going to get electrocuted. We had to get the insurance companies involved immediately. We got everyone basically a check for their homes. I think at the time it was $5,000 or something, just so they had somewhere they could go for housing. I mean, we had to get out there immediately and we had to get in front of just the danger aspect of it, where there was a lot of rebuild.
And I imagine there were a lot of conversations with the insurance companies and was there anything you learned from or you would have done differently? Because in my very uneducated mind, I was thinking maybe an insurance company could have restored it back to whatever, and you could have made a lot of money on insurance claims, and that would have helped. What happened with the insurance, and I imagine maybe they just didn't, you reached your limit on insurance, or what was going on with the insurance?
Well, I mean, we have loss of income insurance, so we were able to help sustain. I think it was over a 12 or 18-month period of time. So that was helpful, where we're able to sustain some of the expenses. But in the meantime, we did a light insurance policy on the homes, which was it's something that if you can afford it, and now it's getting less and less affordable. We insured some of the tenants' homes, even though we didn't, well, all the tenants' homes, even though we didn't own them. And that ended up paying off in a big way where
Nice.
so we were able to distribute that money to people that had nowhere to go. I mean, because their homes were completely wiped out. But in the future, I mean, this was a tough part, but I would require each of your tenants to have homeowners insurance in the property for their mobile home, because that's going to cover that their home's reinsured, and they're going to be able to get it replaced if in the event of a damage like that. But it's kind of hard when you have a lower income park to force them to incur that cost. So that's why I prefer to have a higher level of a community in order that people can afford that insurance.
Yeah. Well, now I'm also thinking about this from a tax perspective. Now, if the property was owned by the tenants, it wouldn't be relevant. But you may have had any property that was destroyed, you would be able to write it off, and you would have the partial asset disposition deduction, which would help you out a little bit on your taxes. So now maybe you don't remember what that looks like, but maybe there were some opportunities where you could completely eliminate some of the assets on the balance sheet, and that'll be written off and would offset or create maybe some capital losses on the sale of the property.
That's a good point. Yeah, no, I mean, at the time, that strategy didn't occur to us, and we were able to get enough insurance funds and be able to have a low enough basis that we were able to sell it at a discount, where some of the new investors came in and built the infrastructure. So yeah, but I could see that strategy working and writing off part of the assets. So yeah, that's a good point, Mark.
Yeah, actually, it's interesting because it would reduce your basis though, and then you would maybe trigger more cap gains, but at the same time, you get a deduction at your ordinary rate and then cap gains at your long-term cap gains rate. So it's an interesting play there. We had a client who does mobile home parks, and it came with some of the units, and the units were not in great shape, so she destroyed the units, replaced them. So we got to write off those units immediately as a tax deduction. And we also, she had some vehicles that were abandoned. And I said, instead of hiring someone to tow them away, why don't you donate them to charity? In fact, people will come, and even lousy cars, they'll pick up the cars for you, and you'll get a tax deduction of donating for charity, and you save money in your business of having to pay someone to haul them out. So a couple of little tax savings opportunities. When we calculated the partial asset disposition in that situation for the removal of the homes that she bought, not a whole lot, but there, every now and then there's some opportunities there that might be pretty cool. Yeah. So some other things that I found interesting in the book, just talking about, I think a lot of people look at real estate investing as a rich man's game, and also a lot of people who enter as limited partners come in with already an established income. And maybe they're physicians, or they have other income to spare to just pop in as a limited partner. And as a syndicator and getting limited investors, that's a great way to do it. But there's also people such as yourself, and maybe some of the people listening who did not start with a whole lot of stuff, right? They didn't start with a lot of cash. And so there's other ways that you can get into commercial real estate investing, or syndication in particular, by adding value in other ways. Can you tell us about some of the ways, and especially if you're resourceful and can find alternative solutions, how can you do this even if you don't have a lot of money? And you explain that you were sleeping on a friend's couch, right? You didn't have to get a day job and work 10 years to save up $100,000 to get your first single family rental. you found other alternatives. So what are some of the ways you were able to think outside the box and be resourceful with what you had?
Yeah, I mean, at the time, I was willing to go to places other people didn't want to go, and I would buy things other people didn't want to buy. So it was, rougher assets in some of the more rural areas of the country, working class communities. But they were older, a lot of capex, a lot of challenging tenants, lack of systems and management. It's just not an appealing asset, but it was in a decent area. It was on the path of progress. It was good services around it. So I mean, intrinsically, it was a good working class area, but there was a lot of issues. And then in terms, it was about going in there and building rapport with the owner, who typically owned it for the 30 years plus, so it's fully depreciated. They had a big tax gain. I mean, a lot of these guys are in the middle America, and they just cannot stand giving to Uncle Sam, or paying any taxes, or at least more than a disproportionate fair share. So they were more open to creative financing or master leases, or even reinvesting into some of the assets. So a lot of times I'd get either the seller would invest, or we'd get creative terms on an installment sale and defer the gains on their end, and I would give them a higher rate of interest, and I had to personally guarantee it. But I also, a lot of times didn't have to come up with a lot of money. I mean, these were small deals. They were 350,000, 450,000, with 25, 50,000 down. And then they grew over time, but going to conferences and meeting people that wanted to be in the space but didn't have the time, I get a handful of investors and learn through what you guys teach. And a lot of these guys were real estate professional couples, and they had high incomes. I mean, one of our biggest investors started at Microsoft and was at Amazon. And those guys, took the ride with me and did a few different small partnerships, but they got all the depreciation. And some of the sellers, they got a lot of good passive income because they carried the note. So I just kind of put the pieces together in a really, you have to find kind of the needle in the haystack. But I mean, this is happening all over the place. It's not like this is like a one episodic, occasion where, you're going to find this every 10 years. I mean, these situations happen all the time. I mean, it's just going out there and willing to get out of your comfort zone and then solve people's problems.
Yeah. So, I love stories about people who think outside of the box to find something. And that's the thing, everybody's got their excuses on why they can't get somewhere. They don't have enough money, enough time. And then you look at the people like yourself, it doesn't, those are just obstacles to overcome that make you stronger. And, like you said in your book, starting off, you said something along the lines of getting your edges, about digging deep, being creative, being ceaselessly looking for ways to get an advantage over your competition. And even in my life, like when I started, a lot of people think going to college is for the privileged. Well, when I went back to school in tons of debt and didn't have any cash, I had to think resourcefully. I had to buy PDFs of textbooks on eBay for my classes because I couldn't afford them. And then some of the questions I couldn't answer because it was an outdated version of the textbook. And the tax law changed.
Yeah.
So, and then I would sell it on Craigslist. That's probably not but anyway.
Right. No, I love that scrappiness, right? That resourcefulness is, and that's why Chris, he was a young guy in his early 20s. We brought him in, and a lot of times when a lot of our sellers didn't have very sophisticated tax strategies, so they'd be in a C corp and they'd have to convert it to an S corp, and you guys know more about that.
Oh yeah.
And sometimes, when Chris came in, it was nice to be able to talk in layman's terms, because these guys, and get their CPA on, where we would buy the units of the corporation, and wait that full 5 years for it to convert. So there was times when a lot of other guys said, no, we're not going to do that. I'm like, no, let's figure out a way to do that. And Chris, we've done that multiple times and found some really, really good deals through that method.
Yeah, I mean, we've been really, really creative on the tax side. I mean, we've gotten, like you said, some really difficult deals done, 2 of them just this last year, where, I mean, literally that was the only holdup on the sale, was buying the corp versus buying the assets. So definitely creative tax structure has been a big piece of getting a lot of these deals done.
All right, so let's we're gonna go into the numbers and the tax stuff. I really want to talk about this stuff, but give us some ideas of some of the creative deals and the tax, how you were able to come in with a tax strategy to help close the deals and find tax solutions.
Yeah, I mean our bread and butter obviously is the installment sale. So it depending on the state that we're in, having the seller carry the first mortgage or the seller carrying a trust deed, that's been one of the better ones, and that's how I started out, right? So it's very simple to explain. You're
Yep.
able to, right, and then typically it's interest only, so that way the seller is only paying, you guys know how they pay tax on their interest rather than their principal repayment. So that was number one. Number two, we did some master leases where they didn't pick up the gain, where we just did a master lease with the option to buy, and we'd put down a decent option payment, and then we'd do the master lease payment, so it technically wasn't a sale. And over that period of time, we would make improvements to the property, like we're doing that now in Naples, Florida. We have one over there, and we now have made improvements to the property and operated it so it's now appreciated by 20-30% minimum. And then now we're going to exercise the option, and they're going to pick up the gain this year. But they were getting divorced, and they had to work some things out, and they wanted to sell it, but they didn't want to they weren't finished with the divorce. So the master lease worked well to delay the sale.
Nice.
But we were able to take on the operational headaches and expenses and everything else. And then what we talked about, the third strategy, like Chris mentions, and he's the one that was instrumental in helping me, is buying the units of the corporation. So whatever, and rather than buying the actual real estate, so we would incur their basis, but we would pick up we buy the units. I mean, and we can get more into that if you like. That was one technique. And then the fourth one was us either having the seller recontribute as an investor, or they would maintain as a partner. So they would pick up the gain, and then they would in turn either carry a second mortgage behind the first, but a lot of banks didn't like that. So instead of that, they would actually contribute back into the asset, and they would be a preferred partner. They would get a special unit of shares, and they would get essentially like a lender, but they would be an actual unit holder, an equity owner, and they would get preferred payments of 6 or 7 or 8 or 10%, and then they would have a disproportionate amount of the profit of the equity or the gain. But they were protected because I would sign a personal guarantee, and I would make them a preferred share unit holder of the partnership.
Cool. So this is really interesting that you bought units of a corporation instead of the property. So were these people who bought the property in a C corp because they were misadvised, or was this an S corp? Or tell me a little more about this.
Yeah, so I think I can kind of take the ball here, Jeremiah. A perfect example is a mobile home park we bought right at the end of 21. Let's see, the family owned it going all the way back to 78, when LLCs really weren't a thing yet, and everything was really a C corp back then. And so the father of the daughters who inherited the park, which is going to come into play here quickly, but owned it through a C corp. So he owned the park through a C corp. Everything was always run through a C corp. That was the advice he got forever and a day ago. Well, he passed away and passed the corporation down to the 3 daughters. And so they got an inherited step up in basis, which is why their CPA continually advised them to sell the units as opposed to the assets. And so they were pretty adamant on that. They were stuck on that. And that was really the selling point there. So what we did is we agreed to buy the units and then made a 338 election so that we could treat it as an asset purchase as opposed to stock.
Oh, very interesting. Very interesting. So here's some great things about installment sales. If you look at the long-term capital gains tax brackets, if you're married filing joint, approximately your first $80,000 is untaxed, you're at a $0 AGI. So some of these people who are retired and they're living off their real estate and they have depreciation, they very well may be at a $0 AGI. But they're selling a large asset where they may get like $500,000 of cap gains all at once, oh boy, they're gonna be in for an unpleasant surprise with their taxes, because you got your long-term capital gains tax. You may jump up to a 20% cap gains if there's enough cap gains. You got your net investment income tax of 3.8 and your state tax on the cap gain. So what you can do here is, if you spread out the taxation of that, you may find you're eliminating hundreds of thousands of dollars of taxable capital gain by breaking out and keeping them in that lower capital gains tax bracket, or giving them opportunity to do other things to offset the cap gains. What we've done, one of my clients had a property for less than a year, and there was a buyer, and I said, the buyer wanted to buy the property and do like a balloon payment after a certain amount of time, but buy it up front and doing a balloon payment in a year. And I said, because you're already transferring the property over in less than a year, you're going to get hit with short-term cap gains tax at your ordinary rate. So instead of that, let's do a lease option. So you're not selling the property. He still has all the benefits of owning it and controlling it. He's going to pay you a little bit over time, and then he can pay you the rest with the option. And now we're converting short-term to long-term cap gains. And now when he pays you, you have enough capital to potentially consider rolling it into a 1031 exchange. So here's where, when you collaborate with a tax advisor and you run the scenarios, you can create lots of savings here.
That, Mark. And there was one point to that, is we've worked with owner users where they use part of the property in terms of an automotive garage, or they have some type of business that they operate and they have a storage facility behind it. And what's nice is they can do somewhat of a sale lease back to us as well, where, we're going to buy the property for $3 million. And I know this doesn't speak to what you were just talking about, but it reminded me of this strategy where, they'll sign a 1 or 3 year lease. We'll increase the price a little bit, and they will have 3 years of rent that they're paying upfront at the closing. And they're still, that way they have the space that they can use. It's part of the transaction. And then they can take the time they need to leave. And then we buy the asset. I thought, and that to us shows that we have a solid tenant in there for a few years, and it's built in the purchase. So that was just a cool thing that we've done in the past, where we solve someone's problems, and it doesn't always have to be the cookie cutter way, where if, we made them leave, we'd have 30% of the property vacated immediately. And we would rather keep them as a tenant regardless.
Yeah. So, and if you could structure a deal that either incentivizes or has good tenants, or create some advantages. We had Lou Brown on talking about affordable housing, and the way he was able to structure this to do it profitably. And now you hear all sorts of horror stories with single family rentals being unprofitable because of lousy tenants, but he did them all as lease options. And so now the tenants are planning to buy all the property. So they're treating the properties like it's their own, and they're incentivized to pay it on time. And the terms will discourage you from not paying the rent on time, because it may alter your abilities to put some of that principal into the down payment of the house.
Yeah, I think it's alignment of interests, and that's what I wanted to get across in the book, right? Was that, if you can get a little unconventional, and you can figure out how to solve problems creatively and add value through that. A lot of times Chris would have to get on with their CPA, and once you get past the barrier of just the trust, I mean, once you understand and can listen to each other, then you can start to have some constructive conversations, rather than someone just saying, no, your offer doesn't make any sense. I mean, sometimes, like I say in the book, there's always 3 aspects of negotiating in real estate: price, terms, and timing, every time. So it's it's not always the price. Sometimes it is. Sometimes it's terms for tax advantages, and then sometimes it's timing. You got to do it fast, or you got to drag it out over time. So if you can get past that and get past the egos, and then you do have a tax professional like you and like Chris helps us, then you can really get to the heart of what are you really trying to achieve here, and let's not get into this. It's my way or your way or no way, and that then it's dead.
Yeah, and especially if tax is a barrier, there's so many solutions out there in the world of capital gains. It's like if you're not going to do the deal because of the tax implications, you really got to question that assumption and help them find the solution. And all these other areas of financing and cash where you can explore all these avenues, you might be able to find some wonderful opportunities here. Let's talk about your current investments now and how the numbers play out and the tax implications. So you guys tell me about your investment portfolio and what that looks like for the people investing in your real estate.
Chris, you want to just share, I guess, just a basic kind of template of our funds and what they are and the amounts and kind of our timelines and returns?
Yeah, so we have a handful of funds. We're on our fourth fund actually right now. Our first fund, we raised $15 million. We offered a 10% preferred return and then a 60-40 split to the investor after all their capital is returned. We stayed relatively in line with that structure. Through our second fund, we raised 25 million. And then more recently for funds 3 and funds 4, we had a similar structure, but added different tiers to investment based on the amount of capital you invested. From a tax perspective, one of the biggest things we like to offer is allocation of losses to all of our investors via doing cost segs on all the properties. So investors are able to see anywhere between 1-to-1 loss and 2-to-1 loss on their investment in the first tax year of our funds, depending on when and how much they invest. So that's really the big kicker from a tax perspective in our funds, but then there's also the double-edged benefit of cash flow with that preferred return.
Right. So
and typically, go ahead.
Oh, so you do a special partnership allocation of the losses?
Yeah, so we do special allocation of losses, and I can get into the nitty-gritty of it, of how it actually pans out from a tax and legal side, but essentially, every capital investor receives a special unit, our A units that we offer in our funds, and then they are allocated 100% of the losses for the first 2 tax years.
Awesome. So now this is an awesome opportunity, and we talk about closing deals and how we can sweeten the deal for the people we want to work with. We've done special partnership allocations. Now it has to have economic substance. You don't just do this for the tax reason. But we've had instances where the cash investor needed those tax deductions. Maybe the cash investor was in a high tax bracket and also had rep status through them or their spouse. And then the other person in the deal was syndicating the deal, had the deal, didn't need the deduction for whatever reason. So now it's best for both parties. We have one person bringing more cash, gets more advantages of the losses from the cost seg, and then the other person gets the ability to share in the cash flow with less cash or zero cash down and give all of these advantages that they don't even really need as much to the other investors.
Well, we'll take a mark, but no, I mean, I'll use the losses, but yeah, no, we want to definitely incentivize and help those guys, all the investors have those losses where we have 2 types of investors, Mark. One is the professional, they're sophisticated. They're, every investor we have is accredited, and they're typically professionals in some area. They're small business owners, attorneys, doctors, in all the different trades. And then we also have a lot of guys that are sophisticated, more retired, passive investors where they live off their passive income, and both of them, either they're utilizing either the losses, really against their passive income. I mean, everyone seems to have a few single family homes. They've done a few projects on their own, or they're just trying to get into commercial real estate, and they don't want to manage it anymore. And, their rentals or in their other passive investments, they want to offset a lot of that cash flow that they built up. So works really well. And then you guys are excellent at explaining the professional status, and then there's all types of good stuff around it, and being able to file jointly and offset some of your earned income if you have a spouse. And we've had a lot of successful professionals doing that, and it's a great team. And I think it's the best reason to get married.
Yeah, it's a good. I was thinking about that. Like, in my mind, I was thinking I could find someone where I'll be like, I'll give you you get citizenship, but you gotta become a real estate agent. We'll get married. We'll make it happen. but you just gotta be a real estate agent, and we'll make it happen. Now we have so I've talked a lot about using short-term rentals, 7 days or less, or having you or your spouse have real estate professional tax status. Oh, thanks for the feedback, Chris. Having real estate professional tax status to use your losses to offset your active income. But even if you don't have rep status, and even if you aren't able to use your losses to offset active income, there's still a lot of tax advantages here, because you're still having tax advantaged income where you're going to be able to not pay taxes on cash flow. That's pretty cool. And then you have these capital gains event when lots of cash hits your account, and there's a whole world of ways that we can offset the capital gains on these transactions. And I just did a podcast on capital gains planning, and there's a whole world of ways you can either completely eliminate, mitigate, or defer the capital gains indefinitely. And also, you may have a lot of people don't realize if you have other sources of passive income, whether it's interest in another business that you're not materially participating in, or maybe we talked about oil and gas. We had a really amazing conversation on oil and gas that a lot of our clients got excited about. And that's a great way to have passive income, and then you can use your real estate to offset that passive income. So there's all these opportunities, and yes, you could have a Roth IRA, you're not paying taxes, but a lot of our clients don't want to wait until they're 60 to get the cash, and you could have a lot more flexibility. So even if if you hate the idea of being a landlord or doing anything, here's a way where you can still invest and see tax advantage cash and build some serious wealth investing in these vehicles.
Yeah, I mean, Chris, you got anything around that? It seems like we've had a lot of newer investors come in, and they didn't even realize that. And I know you got to coach them through it at times, and we're not warranting or guaranteeing, and we're not a tax professional or advisor, but we'll share our opinions. And Chris, have you had your experiences with a lot of different people that have done what exactly Mark's talking about?
Yeah, and I think Mark hit the nail on the head with a really, really important part that I don't want it to go unhighlighted, is that just because you can't take the losses now, right? You're not a REIT, or you can't offset your active income. A lot of people I'm actually having to explain the benefits of this tax deferred cash flow is, just as important as being able to take these losses as if we're a real estate professional. And then, it's, depending on what level you like to play around with your taxes and structuring, it can actually be more beneficial for you to essentially have those losses built up so that you can use them against the gain and recapture that comes down the line. So you're not picking up nearly as much tax as some of these other investors who did take the losses, didn't carry them forward. It's a really big strategy, in my opinion, especially when it comes to these types of investments. I mean, 5+ years of untaxed cash flow is pretty powerful for a compounder.
Yeah, and some amazing exits. Now, also, now you could group these in if you do have real estate professional tax status. You could group these in with your others for material participation and use the losses to offset your income. But here's another thing you could think about. Let's say you're the type of guy with a good paying W-2, doesn't want to leave his job, doesn't want to have a spouse, can't get rep status. So you have all these rentals and they're doing well. At first, you're gonna have the depreciation offsetting your profit. And we're seeing this already for some of our clients. You're getting burnt out because they don't want to change jobs. They don't want to be full-time real estate investors, and they can't afford to take on any more real estate. So now what's going to happen is maybe we've front-loaded that depreciation with the cost seg, or even if we didn't, the prices, the profitability is going to increase year after year after year, and the depreciation is eventually going to run out, and eventually you're going to find that you are actually paying taxes on your rental revenue. So this should be used to offset the taxation on your positive, profitable, taxable rental portfolio, especially for some of you folks doing BRRRRs and finding wholesale deals where you're buying these dilapidated houses, you're fixing it up and renting them up at a really good margin. These are the properties where we don't have access to a lot of depreciation deduction to offset the rent revenues. And you need some way to offset the taxation on your profits and the cash flow.
Yeah, I actually, it's funny. I like to internally, I tell Jeremiah all the time, I call it the snowball effect, right? Once one of these assets runs out of losses, you got to find something new to keep feeding to offset that positive income. Because yeah, you're exactly right. Once at a certain point, depreciation runs out, and hopefully you've added the value to the asset where it's just flowing quite wonderfully. And now you have a great problem to solve, which is offsetting that passive income from that asset.
Yeah. So can you tell me
That's right,
about
Mark.
what were you
I
saying?
think that. Oh, I just think that people that aren't in this world, government and taxation is a mess. Trust me. But the structure and philosophy around it makes sense to me in a capitalistic country and for the most part a free market to a degree. So we are incentivized to actually go out and improve housing, improve commercial buildings, improve infrastructure, and then in turn, take, however you're going to manipulate these losses, or you're going to influence the way that you're going to have your tax strategy. You, like Chris and you just said, you're incentivized to get out there and improve improve the housing and the real estate that we all use. So, at the end of the day, people think, oh, you're not paying taxes. But as anyone knows that's ever been in a real estate investor, and especially at scale, I mean, you are constantly hiring people. You're putting more money back into the asset. You're moving that money and allocating it on a sale. I mean, very few people call it a day and just take their couple $1,000,000 and just stop it. I mean, you got to play the game, right? And you got to go find the next asset and the next opportunity you're going to allocate that cash to.
Yeah. I'm finding a lot of people are slowing down because the interest rates, they have all their reasons. The interest rates, or they're not finding good deals, or they're exhausted, or they're afraid of the market. But the real entrepreneurs and the people who are actually serious are still moving forward and acquiring deals. And maybe they're not doing the same deals. Maybe they're pivoting. So maybe some of our clients have moved into event spaces and glamping and alternative assets, or building new assets, but they're continuing on and finding new deals regardless of what the market is telling them to do or what the masses are doing.
Oh yeah, 100%. And there's so much opportunity right now when you're merging technology, and we're starting to see eventually you're going to find some of this mass produced housing, that we can put across, in terms of remote locations and more sustainable housing. So we're excited. I mean, we're not doing anything at scale with that, but there's a lot of opportunity for small businesses and for affordable housing that we know it's not going away. And if we keep solving that problem, we're going to make our investors a lot of money.
Also, another thing you talked about, improvements, a cool tax opportunity. If you have non-residential real estate, which some of your stuff is, you have qualified improvement property. So if you improve the interior, now there's some restrictions on what type of interior. It can't be an elevator or an escalator, but if you improve the interior, it qualifies as 15-year life property, qualifying for bonus depreciation, that qualified improvement property. We also will do this for Airbnb, short-term rentals, 7 days or less. So that's an amazing opportunity when you're doing renovations to get that additional bonus depreciation.
Yeah, I think what in the heart of it is, why should anyone care about this? Is because what's the point if you get taxed at the highest tax bracket and you're getting a 7 or 8 or 9% yield annually, but you're paying half of it away. There's no favorable advantage, and then you're cutting your compounding down dramatically. Like, what's the point? Like, if you can get a tax advantage 6, 7, 8, and you compound that over 10, 20 years by making the right moves. I mean, you look at the comparison, like, Chris and I do it all the time. This is what we strategize with, weekly. And that over time it's so far and away bigger than what people really expect or understand.
Yeah. You have to think about the tax element of this. Now, you can also get a little bit too carried away. I got some comments on Facebook I think I might be able to get you to.
Yeah, you fundamentally have to, add value and create a good business.
Yeah, but we also want to, now we could also go overboard on the tax stuff. And I've had people come to me and say, hey, I want to start this business, I'm going to buy a truck and all of this stuff so I can get tax deductions. I'm like, well, if you just want to, this is stupid because you're not going to use this truck. Like, why don't you pay me $100,000? Now you get $100,000 tax deduction. We have to think about profitability and economic impact here. So what are we looking at for you guys as far as cash flow, profitability, and exits and capital gains on some of your projects?
I mean, we could dig into it more, and people can obviously come on patriotholdings.com. We can give you the PPM and prospectus, but in the macro, we roughly pay anywhere between a 6 and a 9% preferred return, depending on the size of investor. So right on average, we're about an 8% is what we're doing with our average investment. And then over the next 2 years, I would have to say, Mark, that's probably our target. If we can hit 10 on a true cash on cash, that's an exceptional year, because it's tough. I don't know what your other sponsors or investors are saying, but yield, anything that cash flows, is very difficult with high interest rate environment and recession. And then in terms of, we talked about the tax benefits, a 1-to-1 or 1 or 2-to-1 ratio of passive losses to your investment. So if you invest $100,000, we target $100,000 to $200,000 as a loss. And then in terms of the returns, we're talking about a 5-year hold or a 5-year model. And, we're averaging over 20% as an average IRR return over that lifeline. And it's typically a sale or a large refinance at that between 4 and 5 year mark. But, we do have a good portion of the investment through cash flow, but the value creation is obviously, experienced proportionately in the exit. But what we're doing, Mark, is I believe we're in good recession resistant businesses where they're going to last regardless. And we're not baking in or banking on the investment turning out on the exit. We're not modeling a 5 cap or 5.5 cap. I mean, we're modeling a 7 cap at the exit. If we can't exit, we can still extend out our fixed loans. So we're not under the gun with any, variable rate financing, and we can get, the investor a solid cash on cash return, and it continues to grow. Because the one thing that we are doing right, and that you're certain about, I'm not certain about really anything out there in the investment world, but I am certain that inflation will never go away. And if we can allocate, a currency, and you can allocate dollars, inflating dollars on tangible, valuable, usable assets in the real estate that we own, it's going to continue to go up in value, and we can continue to raise our rents over the long period of time.
So you're the first person to come on who's doing mobile home parks and alternative commercial investments, mobile home parks, self-storage, etc. Why this type of investment?
Well, one, it was a fragmented industry where, the big companies haven't taken it over yet. We're seeing private equity in the space. They want to get in, and they're buying at scale. And I think that's going to be our exit play on some of these storage assets. But additionally, I mean, you target the masses to live with the classes, right? You want to serve the large segment of the population. So, when Chris and I've been in the leadership team, and we look at how we want to grow the business, we've invested in single tenant, triple net, big box, all the office, all of it. At the end of the day, the safest thing, the most defensive and offensive move that we've done is in this diversified streams of revenue, where we have multiple tenants that serve multiple demographics and that provide a high margin of safety, where we're not dependent on one, Dunkin' Donuts or one Sears or whatever, any of these, any one tenant, we can turn our lights out. And for me, that just gave me a lot of peace of mind and certainty that I have control over my destiny, and I have control with my investors' cash, where we can go out and find these assets that we, even in heavy volatile times, they can still survive. But the trade-off is you got to operate the hell out of them. You got to work your butt off, because you can't just hire some third party. They're going to take care of it. It's an easy asset class. It's an easy customer demographic. That's not the case, but there's still a lot of opportunity and upside because of that nature, because of the operational heavy load on the actual investor.
Awesome. Another thing here, you said a 20% IRR. So let's say we put in $100,000 here. We have a 20% IRR. What's that going to look like when we look at, when we exit? Can you explain to our audience what IRR is and how that translates into what kind of cash they're going to make?
I would say just when I'm looking at a passive or active investment, I want to look at, even more than that, what's my multiple? I mean, that's a simple way to look at it. What's the MOIC, the multiple on invested capital? So it's like, and I can teach that to my little cousins. Like, how are you going to double your money, triple your money? Are you going to get, your money back? So what's the investment multiple going to be? So for us on a 5-year hold, on a very conservative investment around that mark, it would be a 2x on your money. You get your money back, and then you're going to get you're going to get additional amount of that money, double your money, but that includes your money back. So that's a 2x multiple on invested capital. And then if you go ahead.
Oh, so I'm just imagining myself. So you get your cash flow, you reinvest your cash flow in other deals, you invest your savings in other deals, they run cost segs, you get deductions building up. By the time you've doubled your cash flow, you may have enough depreciation to completely offset the taxation on that cap gain. And if you don't, then you strategize on some capital gains planning strategies like qualified opportunity zone funds, et cetera, that'll help you get, or maybe invest with the Roth IRA. So many different ways that you can do this.
Right. And that's a good investment. I think anyone right now, we look at everything out there. If you can get a 2x as an investor over a 5-year period in a relatively stable asset, and you can get cash flow, tax advantage cash flow along the way. I mean, I'll do that all day, every day. And then especially if you can, at the gain, when you're actually picking up the majority of the gain on a sale, then, you have a strategy to allocate those funds again into some tax advantage method. That's what you really need to look at. It's not just the IRR is 20 or 25%. It's what do you get at the end of the day? Because people need to calculate that, and that's the thing that Chris has to deal with a lot with different investors. It's not the top line; it's the bottom. What are you keeping after it? So and Mark, IRR. That could be a long conversation, but essentially, just a super condensed way of the way I look at it is if you were able to combine all your cash flow, you combine all the capital gains, and you tally them up over the period of time that you invested, it would then give you what is that average annual return that you would have made over that investment. And that's what gives you, that's how you calculate how much you were making annually based on after the entire investment started and finished and you got all your profits back. That to me is the way I look at IRR.
Great way of simplifying it. What I would like now is for if you could tell us. Well, we also have a tax book that he's on taxes and entity structure on the money edge. And what I'd like you to do is, can you tell the audience about that book? I've been reading through it. I was also, again, it definitely exceeded my expectations. It's very thorough and gives some really good details and insight onto investing and the tax treatment of your investing and structuring and also estate planning. Tell us about the book and also how can people invest in your deals?
Well, first off, it's not been published, Mark, because we want you to be a contributor. So we need you to, we want you to bless it and look at it and put some time into it because and I put a lot of time.
About some of that stuff, yeah.
Yeah. We really do want you to participate in that. We've been working on it over 2 years now with Chris, his father, and myself and the publisher. So we can go down a deep path because that gets quite technical. But essentially, Mark, why we like someone like we want to be on the show and really align with your philosophy is because, we notice that professionals don't like to simplify things. The more specialist and professional that I've found through, and attorneys and accountants can be notorious for this, and financial advisors, that they won't want too much clarity for their client because they don't want the client to feel like they don't need that person. And I'm just saying this is the way I look at it on the outside as a generalist and someone that's a customer or client of you guys. And what we wanted to do is, yes, you guys are the professional. We need professionals. but you need to steer the ship. You are the captain. And if you don't know where to steer it, they're going to steer you in whatever direction they feel like. So, this goes with your attorneys, your accountants, and your financial advisors. You need to have the basic framework knowledge of the game. You need to know the rules. You need to know, like in football, how to get the first down, how to get to the goal line, which way to go. If you don't even know the basic framework or rules, you're not even playing the right game and you're in trouble. So Chris and I went through that and we went over the 6 kind of macro fundamental things that we believe to be a real estate investor, how to set yourself up so you don't get sued and lose everything. And so you advantage yourself tax-wise. That way you're benefiting from already being in the game. And in terms of investing, we just you want to start with that foundation. So you even if you're not wealthy, and you're in your 20s right now, you want to start to, these aren't expensive steps. You want to set up the framework from the start. And this is what you guys help people do. And then that way, when you do experience wealth, you've already created a structure that helps you compound and take advantage of all your hard work.
It's really important that you understand what your accountant is doing too.
Yes.
Because that's going to help you understand what questions to ask the accountant, and also make sure that the return you're signing off on, that you understand at least at a high level what the accountant is doing.
Yes.
And how about, and we really make it an initiative to educate the clients on the tax implications of what they do, but also how to collaborate with us. What events do they need to tell us about? Talk us about these capital gains events before you even have it under contract, so we can strategize beforehand. We wait afterwards, we're limiting our opportunity.
And we believe that's a big advantage with us is, Chris, and being able to give people some insight before the event or at the event of the capital gain, or, how we're going to create the passive losses or the cost segregation study. Giving people the insight on how you can actually strategize your own portfolio has been a big benefit, and, we don't advise people, but we do offer, in terms of information about the investments that we're providing to people and the portfolio strategy, and people utilize that. I mean, Chris, right? This is a big, you have a lot of time out there communicating one-on-one with investors or their financial team. And that way it gives investors clarity into what decisions they need to make over the next 6, 12, 5 years.
Yeah, I think that's a really big piece of, what we do is really getting ahead of it. Right? For example, we know we're exiting an asset in the next 3 months. We're going to be communicating that to the investors. A lot of times I'm going, one-on-one with these. It's harder as we've grown, but one-on-one with the investor, walking them through, here's the recapture, here's the tax implications, here's what we're offering as a reinvestment opportunity, or, here's the implications. So definitely something we get ahead of. And it's definitely, like Jeremiah said, we don't advise, but it's something that you want to build that quality relationship with your CPA. I say this a lot, I'm sure you do too, Mark. If your CPA is just doing your taxes once a year and that's it, find a new CPA, because you need to be planning, especially in this investment space. Constant planning, constant review of what you're investing in, being ahead of the curve, getting into these products is really key. And having your CPA understand what you're doing is the biggest piece to it.
Yeah, we bill monthly, and so we spread out the costs for compliance work and advisory, and it incentivizes the client because we don't charge by the hour, so they're not going to be penalized. In fact, they're going to feel like they want to get their money's worth, so they're going to have to notify us and collaborate with us throughout the whole year. And now the typical, our industry, our profession is outdated. Most accounting firms are what I call 1040 factories, which is what you described. So, Jeremiah, I found some really awesome stuff. I love your Instagram page because you're showing out, you're rolling your sleeves up, you're pounding the pavement, you're going through your different properties. Where can people learn more about what you're doing, all your insight, your materials, and also maybe they want to consider investing in some of your real estate?
Yeah, the patriotholdings.com. I mean, I'm from New England, so I'm a big New England Patriot fan. I believe in the Patriot way, the culture, and that's what inspired me for that. And then, finding your edge, how to win at the game of commercial real estate on Amazon, with the Audible books coming out in the next 3 weeks. I got some extra stories in there, Mark. So, I think it's going to be a good addition. It's not identical at all. And then overall, if people want to see the specific funds, just Patriot Fund number 3 or Patriot Fund number 4.com. And they can get all the information there, and they can set up one-on-ones. And, I think it's a long-term relationship that we have. We don't raise tons of money or we don't raise from institutions. So we really like that, align with what you say, Mark, in terms of, planning long-term, understanding the investment, understanding the strategy. And that's what, and Chris and I are heavily invested. I am, if not one of the biggest investors we have, and I put multiple millions into different funds, and I am guaranteeing many of the debt. So I am heavily invested. I'm not passively sitting back and getting fees because people are allocating their funds to us.
Wonderful. Cool. All right. So, thanks for joining us. I'm going to have all the links to this and any of the resources you'll find in the show notes. And it'll also, you can subscribe if you guys want to hear more. And also for anyone in our audience, not only should you subscribe to the podcast and webinar to stay on top of all our amazing conversations, but also if you or anyone you know is interested in using our services, tell them to email info@markperlbergcpa.com. And also, we're always hiring. Send us some talent. All right. Thanks everybody for listening, and we hope you enjoyed the show.
Thanks, Mark.
Thanks, Mark.